including me.
Hello visionaries, welcome back to my channel. My name is Marisa Talbert. I am the founder and CEO of Talbert Law Office, your favorite go-to legal resource for all things business, nonprofit, and intellectual property law. So I received a viewer question about adding a silent partner in a family-owned LLC. Typically, my response to any discussion about investors and silent partners in an LLC structure is that if you want investors, the LLC is not the proper business structure for that type of relationship. And the alternate consideration should be the corporate entity structure. Now, this is not because LLCs are prohibited from taking on investors, but this is more so because the investor is inherently an owner within an LLC, and in most states, the LLC structure defaults to allowing all of its owners to share in the profits and losses and to have equal say and authority in the decision-making process. As a result, the LLC is not the best vehicle for bringing on silent partners or investors, and doing so becomes fairly complex, which is why most investors hate the LLC business structure. But when there's a will, there's a way. So I do want to talk about what equity looks like within an LLC, and I want to give you 3 considerations if you are looking to bring on a silent partner within your LLC entity structure. Without further delay, let's jump right into it. First, let's define a silent partner. A silent partner is any individual who provides funding to a business as its only contribution. They generally do not take part in managing or operating the business at all. Normally, when a silent partner invests funds, they receive stocks from that company, and those stocks represent equity or partial ownership within the company. As the company grows and earns profit, the owners, including that investor, is not only able to make their investment back, but they're able to earn dividends or distributions as passive income. And this is really easy to affect in a corporation because stocks are inherent to a corporate structure, but they're not inherent to the LLC. So, how does equity work within an LLC? In most states, the default rule without an operating agreement to state otherwise is that the LLC is member managed and not manager managed. If you are unfamiliar with this terminology, a member is an owner of the LLC. So if the default rule states that an LLC is member managed and not manager managed, that means that all members have equal voting and decision-making authority. Some states even require unanimous consent from all of its members for decisions such as sale of assets or amending the operating agreement. This is one of the reasons why I strongly encourage every LLC member to have an operating agreement, even if you're a single member LLC. When you're making business decisions, especially when large amounts of money are on the table, it's so much harder for you to think about these legal and procedural tasks. With that being said, the first thing that you need to consider when you're looking to bring on a silent partner in your LLC is whether you have a sufficient operating agreement. Your operating agreement can opt out of some of those default rules that are automatically imposed on LLCs if they conflict with your intended operations. The second consideration is to understand the types of interests that are available to an LLC. First, we'll talk about membership or capital interests. These are interests where the member contributes capital to the business, and that contribution represents an ownership stake within the LLC, to include profit and voting interests. Membership interests are the equivalent of having equity just like a shareholder in a corporation, and they are treated as such for tax purposes. A member who receives capital interest is taxed on that interest or that income at the time it's granted. And because an LLC has pass-through taxation, the profits earned on that capital interest will trigger self-employment taxes that will need to be paid for that tax year during the next tax season. Depending on other factors, it might also trigger an 83B election. Now that's just a quick nugget. I'm not going to talk about the 83B election, but I mention it because if you are planning to bring on an investor in your LLC, you'll need to consult with a tax professional and you'll have some language to bring to the discussion. On the other hand, there are economic interests. Those interests represent a type of ownership share that only entitles the holder of those types of interests to distributions, but not any control. A common way for someone to receive economic interest outside of being an investor is when a member passes away and they leave their ownership interest to their spouse or their heirs. This allows the spouse or the heirs to receive passive income based on the member's ownership percentage, but it doesn't allow them to be an active member within the actual business. Economic interests generally take on the form of profit interests. Profit interests do not actually represent ownership. Instead, it entitles the holder to a future income and appreciation of the LLC's value. Because profit interests are based on future value, when they are granted, the LLC must take a current valuation of its company at that time. And that valuation becomes a threshold for the minimum value of the profit interest. For example, if your LLC is worth $10,000 today, then your profit interest must be worth more than $10,000 in the future. Furthermore, these interests are initially tax-free until certain conditions are met under the Internal Revenue Code Section 409A, such as holding on to these interests for at least 2 years. You see why investors don't like to invest in LLCs? It's a little too complicated. All right, stay with me. We're almost done. The third and final consideration that I'll discuss today is making sure that you provide an awards agreement for the interest in your LLC. The awards agreement will outline how the interests are to be shared. It may include provisions on how the interests may vest over time, or how those interests could be forfeited. It can also discuss how distributions of those interests will be handled, or it may list permissions or restrictions and how those interests may be transferred to a third party. As you can see, equity interests in an LLC are not simple or clear-cut in any way. This is the reason why I almost always advise business owners to convert their LLC into a corporation if they make mention of wanting to bring on investors, especially silent partners who don't want to have anything to do with managing or operating the actual business. The LLC does not provide a clean and simplistic way of doing that. But I also wanted to take the time to answer this question more fully and explain how equity works in an LLC so that you all are informed business owners making informed decisions, because one size does not fit all. So I hope this video was helpful. Don't forget to like, comment, subscribe, and share with a friend. And as always, this is Talbert Law Office, your favorite go-to legal resource for all things business, nonprofit, and intellectual property law. I'll see you in the next video.